A buy China sell India trade is getting played out in emerging markets as FIIs have sold Indian stocks worth around 58,000 crores in the first 3 days of October. The sudden U-turn in FII strategy has been mainly triggered by the outperformance of Chinese stocks. Given the significant FII selling in Indian stocks and the concurrent buying of Chinese stocks, how sustainable is the current trend of Chinese outperformance? Are there underlying factors that suggest this is a short-term phenomenon, or could it be a longer-term shift in investor sentiment towards Chinese markets? Will this be an opportunity for Indian investors for investing? While the current FII selling in Indian stocks may present potential opportunities for domestic investors, how can investors effectively assess the underlying reasons for this shift and determine whether it represents a temporary correction or a more significant market trend? Additionally, what factors should investors consider when evaluating the potential risks and rewards of investing in Indian equities at this time? So, the question is this just a temporary trend, or is there something deeper going on that could make our market crash? Let's explore. But before going any further, let's delve into the remarkable performance of the Hang Seng Index. In just 1 month, this prominent Asian benchmark has surged by an impressive 26%. How sustainable is this upward trend? Are there underlying factors that suggest this is a short-term phenomenon, or could it be a longer-term shift in investor sentiment? To understand this, we will have to look into China's quantitative easing. There are two perspectives to this. One, India continues to be most expensive market among its emerging peers. Two, China's quantitative easing. India has emerged as the largest emerging market in MSCI EM Investable Market Index (IMI), which includes large, mid and small cap counters from 24 emerging markets economies. On the other side, China's weight in the index has halved since its peak in early 2021. Now, this is where China's quantitative easing comes in. And this is called Buy China, Sell India. So what is China's quantitative easing? China's quantitative easing, QE, is a monetary policy tool used by the People's Bank of China, PBOC, to inject liquidity into the economy and stimulate economic growth. It involves the PBOC purchasing government bonds and other assets from commercial banks, increasing the money supply in the economy. First, asset purchases. The PBOC buys government bonds and other assets from commercial banks. Second, increased reserves. The commercial banks receive cash in exchange for the assets, increasing their reserves. Third, lower interest rates. With more reserves, commercial banks can lend money at lower interest rates. Fourth, stimulated economic activity. Lower interest rates encourage borrowing and spending, which can stimulate economic growth. Given the PBOC's recent monetary policy easing measures, how might these actions impact Indian investors, particularly those with exposure to Chinese markets or those concerned about global economic conditions? Could these policies lead to increased capital inflows into China, potentially affecting currency exchange rates and stock market valuations? Additionally, what are the potential risks and opportunities for Indian investors as a result of these changes in Chinese monetary policy? So let's find out. The PBOC's recent monetary policy easing measures could have several implications for Indian investors. Potential benefits: increased capital inflows. Easier monetary conditions in China could attract more foreign investment, including from India. This could lead to a stronger Chinese currency, which could benefit Indian exporters. Stimulated Chinese economy. A stronger Chinese economy could result in increased demand for Indian goods and services, boosting exports and economic growth. Market opportunities. The easing measures might create opportunities for Indian investors to invest in Chinese stocks or other assets. However, it's important to conduct thorough research and consider the risks involved. Potential risks. Currency volatility. A stronger RMB could lead to increased volatility in currency exchange rates, affecting the profitability of Indian businesses engaged in international trade. Inflationary pressures. If the easing measures result in excessive liquidity and credit growth, it could lead to inflationary pressures in China. This could impact the cost of imports for Indian businesses and consumers. Asset bubbles. A surge in investment into China could create asset bubbles in certain sectors, increasing the risk of market corrections or crashes. Measures Indian investors can take. Diversification. Indian investors should consider diversifying their portfolios to include assets from different countries and sectors to mitigate risks. Currency hedging. Those with significant exposure to Chinese markets might consider using currency hedging strategies to protect themselves against fluctuations in exchange rates. Stay informed. Keep abreast of developments in Chinese monetary policy and the global economy to make informed investment decisions. Consult financial advisors. Seek advice from qualified financial professionals who can provide personalized guidance based on your specific investment goals and risk tolerance. It's essential for Indian investors to carefully assess the potential benefits and risks of the PBOC's monetary policy easing measures and make informed decisions about their investments. But it seems like the Indian government and big investors are both buying up Indian stocks. Are they working together on this, or is there something else going on? Let's take a closer look. The Indian government has not taken any direct action specifically targeting China's QE. However, the government's overall economic policies and strategies can indirectly influence how Indian investors respond to China's monetary policy. Here are some key factors to consider. Domestic economic conditions. The Indian government's focus on domestic economic growth and development can impact investor sentiment and capital flows. A strong Indian economy can attract investment even during periods of global economic uncertainty. Interest rate policy. The Reserve Bank of India, RBI, sets monetary policy for India. If the RBI's interest rates are higher than those in China, it could make Indian investments more attractive to foreign investors, potentially offsetting some of the impact of China's QE. Trade policies. India's trade policies with China can influence the flow of goods and capital between the two countries. If India maintains open trade relations with China, it could benefit from increased economic activity and investment. It's important to note that the Indian government's approach to China's QE is likely influenced by a variety of factors, including geopolitical considerations and domestic economic priorities. Hey everyone, thanks for watching. If you enjoyed this video, be sure to hit that like button and subscribe to our channel for more content just like this. We put a lot of time and effort into creating these videos, so your support means the world to us. See you in the next one.